Hello and welcome to our channel. Today we are discussing the recent policy rate cut in Pakistan. The State Bank of Pakistan has announced a reduction in its key policy rate by 200 basis points, lowering it from 19.5% to 17.5% amid demands for a significant rate cut. But what does this mean for the economy and the general public? The State Bank of Pakistan has the authority to increase or decrease the policy rate according to the economic situation through the Monetary Policy Committee. The Monetary Policy Committee is the key decision making body that sets the policy interest rate, influencing overall economic activity. They make this decision after analyzing various economic indicators to ensure macroeconomic stability by controlling inflation and supporting growth. For the third time in the last 4 months, the State Bank of Pakistan has decided to cut the policy rates. This time, it has decided to cut the key policy rate by 2%. This cut has been made for several reasons. Let's explore these reasons. In August, inflation was 9.6%, which is a significant drop from 38% in May 2023. Lower inflation means prices are not rising as quickly as they were in the past, which can make it easier for people to afford goods and services. Then the global oil prices have dropped significantly. Lower oil prices reduce costs for businesses and consumers, which can help lower overall inflation. Pakistan's foreign reserves were at $9.5 billion on 6th of September. Despite challenges like low inflows and ongoing debt repayments, having substantial reserves provide some economic stability. Furthermore, the returns on government securities have decreased. This indicates that borrowing costs for the government are lower, which can help reduce the cost of debt. The committee also noted that the business confidence is improving, meaning thereby that businesses are more optimistic about the future. However, they also pointed out that the consumer confidence has slightly worsened, indicating that people are still cautious about spending. Another reason why the State Bank of Pakistan cut the key policy rate was that the real interest rate, that is, the interest rate adjusted for inflation, remained positive. The real interest rate shows the true cost of borrowing and the return on savings. Since it was positive, it means the interest rate is still high enough to help reduce inflation to the target range of 5 to 7%, while also making borrowing more affordable. By cutting the policy rate, the State Bank of Pakistan aims to make borrowing cheaper. This encourages businesses to invest and expand, which can boost economic activity and create jobs. The goal to support economic growth while keeping inflation under control. The key policy rate cut is expected to have several significant impacts on the economy. Firstly, by reducing the policy rate, the government can lower its domestic debt servicing costs. This means the interest payments on the government debt will be reduced, freeing up resources for other essential expenditures. Secondly, the cut provides relief to the private sector, particularly large scale manufacturing. Lower borrowing costs make it cheaper for businesses to finance their operations and investments, which can lead to increased production and expansion. Further, lower interest rates make borrowing more affordable, encouraging businesses to invest in new projects and technologies. This can boost economic activity and drive innovation. One also expects that with increased investment and economic activity, more jobs are likely to be created. This is especially important for young people entering the job market, providing them with more opportunities. Lower interest rates can also benefit consumers by reducing the costs of loans for homes, cars, and other purchases. This can increase consumer spending, further stimulating the economy. And lastly, the projected growth rate for the current fiscal year is now 3.5%, up from 2.4% in the previous year. This improvement indicates that previous rate cuts have been helpful in boosting overall economic activity. Despite these benefits, the general public has yet to feel the positive effects. Many employed individuals in the private sector have not received a pay rise in 4 to 5 years, and poverty levels remain high at 41%. The lower inflation rate has not yet translated into a noticeable improvement in the living standards. The monetary policy statement emphasizes the importance of meeting IMF conditions to secure funding. In July-August 2024, Pakistan missed its revenue target by 98 billion rupees, raising concerns about meeting these conditions. The statement notes that fiscal consolidation, which is the government's effort to reduce its budget deficit and debt, is not progressing well, which could impact the effectiveness of the rate cut. But if the government meets IMF conditions, the key policy rate is likely to remain unchanged, ensuring continued economic benefits. In summary, the recent key policy rate cut by the State Bank of Pakistan aims to stimulate economic growth, reduce debt servicing costs, and encourage investment. While the projected growth rate for the fiscal year 2024-25 is now 3.5%, the full benefit of these measures may take time to reach the general public. Meeting IMF conditions remain crucial for maintaining the current economic benefits and ensuring long-term stability. As Pakistan navigates these economic challenges, the government's ability to reduce its budget deficit will be key to securing further IMF support and achieving sustainable growth. Thank you for watching. If you find this video helpful, please like, share, and subscribe to our channel for more updates on economic developments.